friends. This is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. My privilege that I am here with you to talk about scope of financial services. So we will be discussing this topic in two parts. In this session, I am going to address first part about scope of financial services. So friends, in the past we have talked about financial system. Within the financial system, we have financial markets, financial institutions, financial instruments, financial services, financial regulators. So the fourth one, financial services, is something I am going to talk today, right? And in fact we talked about financial services in the past as well. Today I am going to expand it and I shall be talking about in detail all those services which fall under the scope of financial services sector or part. So, financial services sector has grown like anything in the recent past. In India, especially after LPG liberalization, policy which was announced by the former Prime Minister Dr. Manmohan Singh ji. So after that, the financial sector has picked up. Financial services has really gained a momentum in the country, and worldwide it has become a very big industry now. Why? Because financial services are very vital for any economy's stability, growth, because it facilitates the flow of capital and manages the risk, which becomes, that's why this becomes integral part of financial system of any country. And if we say what financial services are, financial services can be called or can be defined as financial intermediation, right? Wherever we need intermediation, and that intermediary services are provided so that the funds are mobilized from the surplus sector to the shortage sector, all that is known as financial intermediation. Means we are not talking about the institutions which provide financial services, not the instrument, they are independent, the service per se itself, right? So basically financial services are economic activities which are provided by finance industry, including banking, insurance, investment bankers, to help businesses, to help individuals and governments to mobilize funds from the surplus to the shortage sector. So financial services are essentially the processes by which consumers and businesses they acquire financial goods and manage their financial resources. It includes banking services, investment houses, lenders, finance companies, real estate brokers and insurance firms which provide these essential processes known as financial services, so that the consumer which is in need of funds, they are able to acquire that. So acquire financial goods and manage their financial resources. Now when it comes to scope of financial services, the scope of financial services can be broadly divided into two parts. Number one, financial services which are fund based, and number two, non-fund services. So accordingly we have two types when it comes to the scope: fund based financial services and non-fund based financial services, which are primarily the fee based services. In this session we are going to talk about only fund based services. The non-fund based services will be taken up in future session. So let's target about the fund based services here. So there are a couple of fund based services which are provided by financial intermediaries, financial institutions, banking, insurance and other financial institutions. So what are those fund based financial services? We have underwriting service, dealing in secondary market activities. Number 3, participating in money market instruments. Number 4, participating in lease financing. Number 5, participating in hire purchase. Number 6, facilitation of venture capital, facilitation of bill discounting. Number 8, insurance services. Number 9, factoring. Number 10, forfeiting. Number 11, house financing, and number 12, mutual fund. Now I shall be explaining all these services in detail to you. So starting with number 1, underwriting. So underwriting is a service which is provided by any of the financial institution to ensure or to smooth functioning or execution of any issue of debentures, bonds, etc. So here underwriters undertakes to acquire the unsubscribed capital or unsubscribed debentures. So they undertake to take care of the interest of the investors. So these are the underwriting services for which they charge, of course, a heavy fee, and the premier institutions are into underwriting services. So this is the fund based services, because the underwriter takes to underwrites or undertakes to actually acquire that amount of the issue which is not been subscribed. Let's say, for example, if company has issued 1 lakh shares of 10 each, means 1 crore worth of shares, but actually 80,000 shares of 10 each have been subscribed. So underwriter has undertaken to subscribe unsubscribed capital or issue. So here 20,000 shares are unsubscribed. So 20,000 into 10 each, right? So this is the amount which the underwriter institution would be paying, and the issue will be fully subscribed. So the underwriter becomes the fund provider. That's why it falls under the fund based financial services. If it doesn't has to do that fund providing, no, anyways, in both the condition, it is charging the fees for the service, a very high fees for the service. The second point was that dealing in secondary market activity, primary market and secondary market. In the primary market, the first IPOs are issued. In the secondary market, sale and purchase of financial instruments or financial securities does take place. Now, there are many financial institutions which participate in secondary market activities, right? They purchase, they sell the shares which has already been there in the market, bonds, debentures, futures, options, everything. So they are dealing in secondary market. So there are financial institutions which are focused in dealing with secondary market activities, not primarily financial market. Then the point number 3, the scope, under the scope or financial services, the fund based services, participating in money market instrument. Money market instruments are the one where the loan is provided for short term. Secondary market activities are generally long term, whereas money market instruments like commercial commercial papers, treasury bills, they all are taken or known as money market instrument. So here financial institutions participate in that. How does a financial institution participate? So for example, the government of Haryana issued treasury bill for 90 days, because government of Haryana need to release money for any scheme or needs funds for any project. So they are short of fall of some funds. So they issued treasury bills. Now any bank, it could be SIDBI, it could be ICICI, it could be Punjab National Bank or insurance company, anybody or any of the institution which is financial institutions who have money, who have enough understanding, they will buy treasury bills. So, and which means a bank is extending loan to the government of Haryana. Same thing can happen to the central government or any state government, right? So this is how financial institutions are participating in money market instruments. Treasury bill, commercial papers are issued by private sector, whereas treasury bills are issued by government institutions, government in general, right? So this is how, this is the third, this is the scope of the financial services, fund based service. Number 4 is participating in lease financing. Now what is lease financing? Let's say there's a company which need to have machinery of worth about 100 crores to run any particular product or to produce any particular product. So company has two choices: if the company has fund, or if the finance committee approves, company may purchase those machineries of 100 crore. But the other option could be, which is very familiar, which is very common in Western world, that instead of buying the machinery, because maybe after a year or two you may change the product itself, the product design may get changed, or you may not like to continue in the business. So that becomes easy if you have lease financing. Here the machinery would be actually purchased by the financial institution for you. They will provide you. So investment is not by the business, the end user of that machine, right? Not by the business, by the company, rather it is by some financial institutions, right? So this is how, so it's a fund base, because the fund to acquire the machinery of 100 crore is provided by the financial institution. So machinery comes to the company, company uses it, company pays fees for it. The lease rent is being paid by the company, whatever the decision both have mutually agreed, and the ownership remains with the funding institution. The lessee is the person who, or the company which is using it. Lessee is the one, the financial institution is lessor. So lease financing, there are two major parties: financial institution which is working as lessor, and the company which is working as lessee, which is actually the end user. So this is how any financial institution will participate in financing activity, right? So this was the fourth service under the fund based financial services. Coming to the fifth one, of participating in hire purchase system. Hire purchase system is different than lease. In the lease, you are not buying at all. In operational lease, in financial lease, there's a concept is different, right? In hire purchase system, you intend to buy, but you are not paying fully. You don't have money to pay fully. You are paying the purchase price in installments, right? Let's say if it was 100 crore and you have 5 crores in hand, you will give the 5 crores straightway, and for the remaining amount you may pay 5 crore each installments for next 19 years, or with interest it could be a little different, right? So 5 point something as crores for the as a hire purchase installment. So in the hire purchase, how the financial institutions are? So in the hire purchase, if the company doesn't have that even 5 crore, so here ownership will come to the company which is buying machinery of 100 crore after it pays the full amount. Till then, the financial institution which is funding is the owner, right? So in hire purchase system, the company is owner to the extent it has paid the money, but legally the ownership is not transferred unless the full money is being paid. So here the financial institutions are participating in facilitating the hire purchase, of course, of high amount, by the corporate. Then facilitation of venture capital, and there's another way, indirect way. Hire purchase, people are buying even air tickets on installments. People are buying refrigerator, fridge. So it could be a group of, let's say there are 100 purchases of a refrigerator from a particular store. So the bank could be financing those 100 purchases to a particular vendor, like the seller, dealer, right? Even that is also a participation at a retail level. Participation of financial institution is possible. Banks are generally into that kind of hire purchase sport. Then facilitation of venture capital. Venture capital is the initial funding which is being provided to start the business. So venture capital is actually getting the ownership of, because the risk is very high initially when the business is yet to start, and that is when the company or business requires fund. Later on, if it starts earning, it may have its own funds which are saved and can be utilized, can be reinvested. But here the venture capital is something which is being actually paid, which is being paid, which is being provided by the financial institution. This is also a financial service, because VC funding is could be done by individual, it could be done by financial institution. In both the way, it is a service to help you establish a new business and or experiment a new idea or a product. So that is number 6, which is fund based, because a fund is provided, not only the fee. Then facilitation of bill discounting. So bill receivables are the outcome of credit purchase, as credit sales, as we all know. So if a company sells something on credit, so it gets bills, BRs, bill receivables, in lieu of those sales. That is a promise, legal promise to pay you in some time, in 30 days, 20 days, on these many terms, 6 by 10, 6 by 20, 4 by 10, whatever the terms and condition, the days and the rate of interest, right, both are mentioned on the bills. So here, if some business has bills, bill receipt, or more than one, and it needs money, right, before the due date of the bill, what is the possibility, what is the option the business has? The business can actually go to any of the financial institution and get that bill discounted, of course by paying a commission on discounting, right. So there, so the company gets money immediately, and later on the financial institutions who purchase your bill, they will be collecting from the real buyer, the original buyer of the supplies the business has made too, right. This is how the facilitation of bill discounting comes under the purview of the financial services, because here it's a fund based service, because the complete fund requirement equivalent to the amount of bill is been provided by the financial institution. Then insurance services are very common, and we all are well aware of the services. In insurance services, be it sale of the policy, purchase of the policy, be it claim settlement, be it guidance during the, be it mentoring, be it any kind of service pertaining to insurance. So where the risk is spread, risk is covered through the insurance. So insurance services are all these services which I just mentioned are part of insurance services. They are fund based financial services. Then another financial service is factoring and forfeiting. These are the two. So factoring is something, we have trade receivables, we have loans which we are going to receive as a company, as a business. We can reach out to a financial institution. So by charging a factory fee, those trade receivables, they can be given or they can be paid to you as a business immediately. And there could be two options that, so they are, when we are talking about the factoring, we are talking about the local receipts, local bills receivables, local trade receivables. So these are the trade receivables or the loans which has been extended by you to somebody, which becomes your asset. So it's kind of selling your asset to the financial institution. They would be collecting and they would be actually be taking the risk of receipts or non-receipt. The factoring could be that when the complete risk is transferred to the buying financial institutions, it could be without the complete financial risk being transferred. Both of the options are there, both kind of options are there. Whereas in forfeiting, what we are doing, in forfeiting, here the bills, that the amount which is to be collected from the overseas buyers. Let's say if there is a company which is into export import business. So if it is selling something outside, means it is exporting. So if it has exported, let's say rice of worth 100 crores in the month of March. So and has been issued receivables by the buyers in, let's say, any country, because interestingly this week only the India became the highest producer of rice this week itself. we surpassed, we become the number 1 rice producing country in the world, which is really commendable, right? So if and we are exporting, certainly we are not importing rice, so that's how I took this example. So let's assume that company has exported rice of and for 100 crore and has been given a promise, an LC has been issued, you would be paid back in 30 days, 40 days, 90 days, 60, whatever the terms and conditions are. But you need funds. You need funds to buy another lot of rice and to sell it again to the next prospective buyer and keep your business rotating or running. So in that case, you can go to the financial institution and you can forfeit these receivables, and you can get the money before the due date. So forfeiting belongs to the foreign receipts, whereas factoring is taken in case of the BRs which are due from the country, within the country itself, right? So this was number 10. Number 11, house financing. What is house financing? We all understand, I believe. So house financing is also another fund-based financial services. So it comes under the scope of fund-based financial service. So when I say fund-based financial service, it means a fund is provided, it is not the fee-based only. So here house financing, as the name suggests, is a loan or the financing of the purchase of house, renovation of house, rebuilding, redevelopment. Imagine there are companies which are actually buying land, developing houses on that, flats or apartments on them, selling it, and they are investing huge amount. And there are people who come together, there are financial institutions who become partner in those projects. I have seen many projects in the city of Gurgaon, it's because it's growing like anything, growing crazy in fact. So house financing, what is happening? The financial institution is providing funding, right? It could be to individuals, as if I bought a house and I can go and get the loan from the housing loan. So who is doing the house financing? There are many banks who have a separate house financing departments, house finance. We have PNB house financing, SBI house financing, ICICI house financing corporation. There are so many companies which are subsidiaries of banking or banks or banking institutions, and they are exclusively in the in the services of house financing, right? So here this is the most commonly known service which we are availing as individual, as corporation. And this house financing is not always for buying a new house, mind you. If you have a house already existing with you, you want to redevelop it, you want to rebuild it, you just want to renovate it, you just want to do some modification it, even, and if you get the financing, even that is house financing. House financing doesn't mean financing received to buy a new house only. It could be for farmland, it could be for land itself, not a house. So this is what the house financing is, and this is a financial service, and it is a fund-based financial service. The last the last point I want to make is the mutual fund. Mutual fund industry is not very old in India. Initially, it didn't pick up at all. People were hesitant. People like me, even who are educated, who are in the finance sector, were reluctant, were hesitant in investing it. But gradually, the mutual fund industry is growing at a good speed. Still not as mature, as good as it is there in overseas or many part of the world. So in mutual fund, what is how it is a fund based financial service. In mutual fund, investments are basically what is happening. The company is collecting money from retail investors, right, and then is investing in the mutual funds, of different type of funds. Those funds could be equity based funds, those funds could be only debt based fund, those funds could be balanced where both equity and debt is there. So this is what, any combination, it all depends, and you as an investor can choose that you want to invest in only equity or debt or balanced. You can choose you want to invest in large cap companies or mid size company or small cap companies. Even you have the choice for that as well, because generally it is perceived that the small size companies are likely to give you high return but high risky as well. If there's a decline, there's a possibility of a very great big hit by or by the market to these companies. On the other hand, they are the most rewarding one. So mutual fund services are the services where the investors are supported to invest in a mutual fund, and there's no dearth of companies which are working in the mutual fund, and there are so many services in the mutual fund industry. So in total we have discussed about 12 services which are fund based financial services, right? And they are under the scope of financial services. I hope friends you were able to understand these services very well, and I really appreciate your attention time during this session. Thank you very much. Time to sign off. Thank you.